Welcome to Choosing the Proper Business Entity Structure, hosted by the Urban League of Greater Philadelphia.
Yvette Mitchell has really been part of the Urban League team since about a year after we launched. I think you joined the team in 2010-ish, and she has an auditing background. She's an accountant. She's done quite a bit. So I don't want to risk butchering her introduction. So I'm going to turn it over to Yvette. Yvette, you have the floor.
Tonight, we're going to talk about choosing the proper entity structure. As a business owner, you definitely want to determine how you want to structure your business. So the first thing we have, and this would apply to all of us in our category when we first started our business, are our sole proprietors. By default, you and your business are the same person. You have no legal protection. There's no tax strategy in that. And so when people say, oh, I pay a person under the table, or I'm getting money under the table, technically you're not. You're just a sole proprietor and you're not paying taxes. So there's no such thing as under the table. So with that status, you just unincorporated business. You still legally can be in business and be considered a business. You do not have to have any type of formal structure. I personally tell people, if you're going to run your business like that, at minimum, at least get a EIN number. So you're not, because when you're working with vendors and you're working with companies, they may ask you for your tax ID number, and you don't want your social security number out and around. So you may, at minimum, I will tell people, just get you an EIN number. As a sole proprietor, you're going to be subject to self-employment tax, Social Security, and Medicare. So this entity, again, is just at bare minimum. There's no cost, no startup, but this could put you in the highest, depending on how much money your business is making, this could put you in your highest tax bracket. So you will have to be careful here. From a legal standpoint, you and your business are the same person. So if someone sues your business as an unincorporated business, they're also suing you, so they can come after your assets. So that will lead me to our next one. So, hey, you might want some protection from your assets. So this is kind of, I call it the default. So a lot of people, hey, I have an LLC, which is what the IRS really considers a hybrid type of company. So it's a mix between a sole proprietorship and an S corp. It provides limited protection to its owners. And when I say limited protection, the protection is a person can only sue you to the extent of the value of your business. So it does provide some type of protection for you, but it's not full protection. The only good thing is the owners or the members, you're not personally liable for your company's debt. So if you were to get a credit card, if you were to take out a loan and you technically defaulted on it, it's not your loan, it belongs to the company. So that can never show up on it should never show up on your credit report. For tax purposes, it's considered a disregarded entity. So with that being said, you can be either taxed on an individual level with your Schedule C. So some of you now, if you started your business before you set up a legal structure, you were probably reporting your income on a Schedule C. If there's two or more members of the LLC, by default, it becomes a partnership. That's not a choice that's up to you from a tax standpoint. That's what it has to be. But you can choose, and depending on how your business grows and how the structure grows, you can choose and petition the IRS to be taxed as an S corp. As your money coming through an S corp and going straight to a Schedule C. From a tax standpoint, if your money is coming through a Schedule C, you are paying, not only are you paying your regular income tax, you're also paying self-employment tax, which adds another 14.5% to your tax bill. So if you were being taxed at, say you were being taxed at 25% or 27%. On top of that, you're going to pay self-employment tax of another 14.5%. From a tax standpoint, a limited liability company as a disregarded entity or a Schedule C, there's no tax advantages to that at all. As a business owner, you should have 2 people on your team at all times, and you can always work with their accountant and a lawyer, because as a business owner, you're going to run into legal issues and you're going to run into financial issues. So you want to engage with your person as soon as possible. Let's talk about our next legal entity formation, which is an S corp. An S corp is an entity that opts to be taxed under it's actually the Internal Revenue Subchapter 1 code. So that's how it has gotten its name, S corp, based on the U.S. Internal Revenue Code. The S corp is what we call a pass-through entity. So when you file a S corp tax return, it's typically what I call an information tax return. The IRS want to say, hey, how much did you make? How much did you spend? Who are the owners? Who owns this entity? So that's where an S corp comes in. And so what happens is when you file an S corp tax return, there's no taxes due. That tax will flow through on what's called a Form K-1 to the business owners. Owners are treated as employees and may draw a reasonable salary from profits of the business. Just to do a back step, if you are the owner of a limited liability company, technically you should not be on payroll. You can't pay yourself via that. I have clients who are limited liability companies and they do issue themselves a check. They're not going to get in any trouble for it, but that's not the best way to do it. I'd rather for them to do that and pay some taxes than not to do it and don't pay any taxes. So we kind of come up with some hybrid strategies. But as an S corp, you definitely want to make sure you're drawing a reasonable salary. And so reasonable salary, if you can't figure it out, the IRS will figure it out. So let's say I'm running my accounting firm. I have been in the accounting field for over 30 years. And say my company is making $2 million. And I said, oh, I'm as an accountant of this company, I'm only making $50,000. The IRS could come back and say, now a person with your skill set and what you do, we don't think you should be making $50,000. We think you should be making more. And the IRS can require that you adjust your salary, and they can go back on all the years to figure out the money that you've taken out of your company to live off and tax you on that. So I always tell people we have to be very careful. And one other, as a tax accountant, what I always tell all of my clients, tax planning does not happen on April 15th. So as we're entering into this last quarter, we're midway through the third quarter. But as we get ready to enter into this third quarter, I'm going to challenge all of you to start really looking at your books, connecting with your accountant, your tax person, and say, hey, this is where I'm at. What do you think my tax burden is going to look like on April 15th? So we don't want to wait until April 15th. When I first started this business, I had people who would wait until the 19th hour to file their taxes and then not understand that they made $500,000. So imagine paying self-employment tax of 14.5% on that $500,000 plus your income tax. That would put your tax rate at almost 50%. That 500 puts you in at 37%, plus the other 14, you're almost at 50% tax. So you have a $500,000 net income, you're looking at, you're going to pay a couple $100,000 in tax that the IRS technically says is due on April 15th. Also, you want to connect with your accountant or your tax person prior to April 15th and talk about what are you trying to do and what are you trying to achieve with your business. Because it's very important. If you know that you're trying to buy a house in 2025, we need to really take a good look at your income in 2024. We should have been looking at your income in 2023. So tax planning and planning your business does not take place at the end of the year. So as business owners, I challenge all of you around November, December, take a day or two, do your own mini retreat and brainstorm the direction you want your business to go into. So S Corps, here are some of the savings. It passes through taxes. As a business owner, you can write off your own salary. You can write off your salary. But if you were on a Schedule C, you don't have a salary, so you can't write off your own salary. It reduces your self-employment tax liability. Any remaining profits in the business are distributed to the owners as dividends, and dividends are taxed at a lower rate than earned income. Or if it's not a dividend, it would be considered passed through, and it's still taxed as investment income, which is lower than your that 14%. So if you decide to sell your S Corp, you can sell the entity without incurring any new tax liability. So that's some of the advantages of S Corps. Now we have what's called the C Corps, and I say these are the large organizations of the world, but the more and more I'm studying business and understanding, a lot of these large corporations are LLCs. And they flow up into a corporation that is what they consider a holding company. So this is really asset protection, not a super tax strategy, because you could end up paying double taxes. So I'm just going to read the PowerPoints, so a corporation conducts business, realizes its net income or losses, it pays its own taxes. The profits of the corporation is taxed to the corporation when earned, and then it's taxed to the shareholders when it is distributed. So that's where the double taxation comes in, because the corporation just can't hold that money. A corporation has owners, right? So we have to give that money out. It's either going to be through dividends, it's going to be through whatever shareholders pay out. The good thing about a corporation is separate from its owners. It pays its own taxes. There's generally no personal liability. However, if you are an owner of a small corporation, this could be an S Corp, a C Corp, or an LLC. As a business owner, you and your business are supposed to be separate. So we cannot see you. I've had clients, I've had to get on them about all kinds of things. I've clients that I see Louis Vuitton, Gucci, Bloomingdale's, Lord & Taylor's, Nordstrom's purchases. And they said, well, these were gifts to clients. So I'm going to go into a little thing about gifts. IRS says for your clients, you can only give them one gift a year that value not to exceed $25. So that Gucci bag that you bought for $1,500, we cannot call that a client gift, because the IRS says, no, you can only give client gifts to a value of $25 per year. There are a few exceptions, but it doesn't get much bigger than that. So therefore, but if the IRS deems that you and your business, they can't tell the difference between you and your business, because you're using your business income to have lavish vacations for you and your family. You're taking your wife, your kids, your husband. Everybody's going on vacation on the business dime, but no one works for the company but you. The IRS says, hey, I don't know where you and your business separate. So everything becomes you. And so you no longer have that protection. So that's a term that they call piercing the veil. There's holes in that veil. So that protection is not there anymore. So you have to be very careful. I always get my clients always laugh at me because I'm like, you're stealing from your company. If you're taking money out all willy-nilly, even though you have access to it and not accounting for that money, technically you're stealing from your company. So you have to be very careful because when it comes down to an audit, what people don't realize, a tax return is a legal document. And so that's going to tell the whole story. And then the next thing they're going to ask you is for all of your bank statements. Every single time my clients get an audit, the first thing that they ask for, sometimes they don't ask for it, they'll go directly. The IRS can go directly to your bank and get your bank statements. They don't have to wait for you to consent or any of that nature. So the first thing they do, that's why I tell people when I say, you want your money direct deposit? I don't want the IRS to know my business. They already know it. They already know where all your money is already. So that's never an issue with the IRS. So I just say, as you're running your business and you form these legal entities, remember all of the entities we were talking about are all legal entities. All of them aren't asset protection or tax sheltering entities, but they're all legal protection. So you have to be careful that you and your business aren't, you're not mixing your business with your personal. So I do suggest business owners to have a separate bank account for your business and one for yourself. So a LLC is flexibility in taxation. It provides legal protection, and it has very few formalities. Like you don't have to have meeting minutes. And I'm going to go back to that now that I thought about it. You don't have to have meeting minutes, annual meeting minutes. You can just open up your LLC and say, bam, it's open. An S Corp is a pass-through taxation, and it has limited liability that it offers to the client. So the S Corp is itself. S Corps, again, they can be formed at a state level, or you can ask the IRS, petition the IRS to be an S Corp. Again, I say I take the cheating route, so you don't have to spend all the additional funding that goes with starting off as an S Corp. Those because taking out an ad in a legal paper, that could cost you $1,000+ to take an ad out in legal paper. So remember, I told you will have to take out 2 ads, one in a legal paper and one in your local paper. That's just like when you change your name, you have to take out those ads because as an S Corp, they want to know who you are. And then there's a partnership. Partnerships is 2 ways you can form a partnership. You can just say, hey, Jordan and I, we just started a business, Mitchell and Tucker and Mitchell. We have a partnership. We don't have to legalize it. We don't have to make it an LLC. We don't have to make it an S Corp. We just saying, hey, we're a partnership. And it's perfectly legal. So you don't have to format. But will we have any protection? No. We will, Mitchell and Tucker and Mitchell will be the same people. We will have no legal protection. So you have to be careful with that. So a lot of times you're doing business with somebody, don't realize that you are in a partnership. The only thing I would tell people about a partnership, if you're going to be in partnership with someone, make sure you have a partnership agreement. Again, it's very important to make sure you're getting your accountant and some type of legal advice as you're creating these partnership agreements, as you're starting your business. You want to make sure you have those type of things. This is a very important page. It just kind of gives you the overview of your business. So as an S Corp and as a C Corp, You have to have meetings. Meetings are required. Annual meetings are required. So those of you who are thinking about an S corp or an S corp, remember I said take that day to work on your business. That should be the day that you have your meeting, and it could be a meeting with yourself, but you just have to write down what your resolutions are. Though, if you were to get sued, the first thing they're going to ask you for are your board minutes. They're going to ask you for your tax returns. They're going to ask you for your bank statements. Those are the three things that they're going to attack as a business owner. If you get audited, those are the three things that they're going to ask you for, because they're going to attack, because that's going to tell a lot about your business. You have to just kind of figure out what are your goals, and you also want to, again, consult with your tax advisor or your legal expert to get personalized advice that is more specific to you. And for my last thing, because of my certification to the IRS, I do have to read this word for word. To ensure compliance with requirements imposed by the IRS, we inform you that any tax advice contained in this communication was not intended or written to be used and cannot be used for the purpose of avoiding tax-related penalties under the Internal Revenue Code or promoting or marketing recommended to another party any matters addressed therein. So I just, after every lecture that I do, I always have to read my Circular 230 disclosure.